Hi, my name is Jim Hayes, or as I like to call myself, I'm the residential real estate investment guru. And our topic today is cash flow. It's one of the 6 major reasons people get involved in residential real estate. Now, I'm going to tell you a little bit of difference than what most trainers are going to tell you here. I see this as one of the reasons. A lot of trainers are going to tell you this is the main reason. They get really hung up on cash flow, and they think you have to have a large monthly cash flow in which you can to have a big return on investment each and every year. That's not the way I teach, okay? I teach that you just need to be able to have a house that pays for itself. And if you do that, then through the appreciation of the home and the debt pay down of the home, there's going to be a nice little egg, a little golden egg that's created. And that's why I call residential real estate the goose that lays the golden eggs. Because that nice little golden egg is going to be a tax-free cash out refi that you can do every 5 years. So we need to talk about how do we make it so that we do have a little bit of a positive cash flow, and it's going to depend on how much cash flow you want, on how much investment you make. Let's take a look. I'll give you some examples. There's a couple of different ways we could do this. Actually, there's a lot of different ways we could do this. I'm going to show you a couple examples. Let's say we have the house, a $250,000 home, a little 3-bedroom, 2-bath house. We could do a 20% down payment, which has an 80% loan of $200,000, or we could do a 30% down payment or a 70% loan of $175,000. Again, you could do anything you wish. You could do a 75%, you could do 80, you could do 60, 40% down. You could do anything you want down. It's going to depend on how much cash flow you want. But I'm going to show you 2 examples, okay? Obviously, the more money you put down, the better cash flow you're going to have. But what I do not recommend is that you pay cash for the house. There's a lot of investors that think that's the best way to go. You pay cash for the house, therefore you can actually reduce your rent, and oh, it's great because you're always having your house rented, but you also mess up the market. I don't recommend that. But number 2, the big reason I don't recommend you pay cash for the house is because all the income that you're going to be making will be taxable to you. You'll pay your marginal tax rate on every penny you make coming back as cash flow. I believe in teaching you how to make every penny you make in cash flow tax-free. Let's take a look. Here's a couple examples. Here's one example in particular, and then we'll look at the second one. Okay? Let's say you put 20% down on this house. So you have a $200,000 loan. And on our example here, we're going to say that the interest rate for an investment loan is 4.625% for 30 years, right? Yes, I believe in a 30-year loan, not 15, because I want the payments to be as small as possible so we can get as much cash flow as possible. That's the goal. But we want the cash flow, again, just to take care of the house. We don't really care about making a large cash flow. We just don't want the house to make a negative cash flow. And even if, to be personally honest, if it was me and my investment, even if I had a $50 to $100 negative cash flow every month, it wouldn't be an issue to me. That's tax deductible to me, and I know every 5 years I'm going to have a very nice, tax-free cash out refi golden egg to be coming. But let's take a look at this example. So, if we had 4.625% interest rate on a $200,000 loan, the principal and interest of that would be $1,025. Now, in the state of Texas, where I live in the northeast Dallas area. Our tax rates here are very high, and it's because we have no income tax in the state of Texas. Therefore, our property taxes are rather high. So our property tax on this kind of a house would be $500 a month. Our insurance in the state of Texas is also rather high because we have a lot of hail and tornadoes and high winds around in the Texas area. So therefore, our insurance tends to be a little higher as well. In this example, let's say about $110 a month. Now, I'm going to highly recommend you get a property manager. Why? Because I am one. I am a property manager, and I would recommend you hire me to help you with your homes if they're anywhere in my neighborhood, right? If you're in the Dallas area, I'd love to be your property manager. And these are all negotiable. I have several different ways that you could pay me. For the example here, I'm just going to say it's $100 a month, okay? Then also, the homeowners association. You probably want to have a house that's in the homeowners association that helps the area appreciate at a better rate. And let's say this one is $40 a month. And then finally, I recommend you get a home warranty. That way, if the air conditioner goes out, the heater goes out, the water heater goes out, it doesn't cost you a fortune to get these things fixed. It's usually just a service fee, right? So I'm going to say it's about a $50 a month expense for you. If you add all this together, it means your total payment on this house would be $1,825. Now, for a $250,000 home, a little 3-bedroom, 2-bath house, you're probably going to end up somewhere in the ballpark of 1,650, 1,750 square feet. Excuse me, maybe even 1,800. But it's going to depend on the neighborhood and that type of thing. Now, the nice thing about having the smaller homes in the nice neighborhoods is you can raise your dollar per square foot on your rentals. So that's probably going to give you somewhere around $1,850 per month rent. So if you get $1,850 a month rent and you have an $1,825 total cash flow, that's going to give you a $25 a month positive cash flow. Now, I know that's not a lot of money, and you're not going to write home to mama about that. That's not, return on investment's not going to be exciting, okay? However, it gets better when you take into consideration depreciation and other assets. But we'll talk about that in the depreciation video, which hopefully you've already seen. If you haven't, you need to watch that. But there's better ways of making returns on the long term than just trying to worry about the short term, okay? So that's this example here where we're at a 80% or 20% down, 80% loan. Let's take a look now at a 30% down, 70% loan. So now we only get a loan of $175,000. Now, not only you have a smaller loan, you also have a better interest rate because you have less risk. You put more money down. So now let's say the interest rate's only 4.5. That makes your principal and interest drop to $887 a month. Everything else stays the same, then that makes your total payment $1,687 a month. You still got your $1,850 rent, so now you're making $163 a month positive cash flow. That's almost $2,000 a year. That's not bad, okay? And it's all tax-free because as we did in one of the other videos, we showed that as long as the depreciation, which was like $6,700 a year on this type of house, this cash flow is much less than that, so all this cash flow would be tax-free to you, okay? Now, if you want more cash flow than that, then you have to put up more money on your down payment, right? So it just depends on how much investment you wish to make. If you want to put 40 or 50% down, then you're going to get more cash flow. I don't recommend much more than that because, again, I want the cash flows to be smaller than the depreciation, okay? Why? Because I want your cash flows to be tax-free. Hopefully this makes sense. So I want you to understand cash flow, is it important? Yes, it's important. Does it have to be a big number, positive? No, it doesn't. But it's up to you and how much you want. Therefore, it depends on how much money you have to put down and how much cash flow you're going to get. If you have any questions about anything I'm talking about, hey, feel free to give me a call or a text. My number is 214-207-9682. Again, my name's Jim Hayes. I'm the residential real estate investment guru, and I look forward to talking to you. You have a great day. Bye-bye.